The US government is doing something you almost never see. It's buying back its own debt through something called Treasury Buybacks. Cool and normal, right? Well, and look, it's not just a little bit at a time, but it's happening at an accelerating rate. We're talking about $138 billion in treasuries so far this year, almost double last year's entire total. But with the national debt now over $37 trillion, these buybacks are never going to be enough to wipe it all out. So the real question is, why are they even doing it? Why would the world's biggest bond market, supposedly the safest and most liquid one on the planet, need its own government to step in as a buyer? It's a good question. So let's talk about it, because the answer is more shocking than most people realize, and it has massive implications. So let's start here by unpacking what is going on below the surface in the US bond market. I'm just thinking, oh, bonds, boring, boo! I know, but this is one of the biggest markets in the world. And the US bond market is critically important to global liquidity and really everything oiling the system. The US Treasury acts as the government's banker, so when the government wants more money to do more things, the Treasury raises more money by issuing more bonds, basically an IOU, with the promise to pay back the investors who buy the bonds. Because your tax dollars are not enough to fund everything the government wants and needs to pay for. But this year alone, the Treasury has already bought back, again, $138 billion worth of its own bonds, and the year is not even over yet. They've done this on behalf of the government. In June, they ran the single biggest buyback ever in history, with the Treasury buying back $10 billion in US bonds from investors on one single day. But here's the red flag. Investors were already lining up to dump $29 billion worth of bonds on the open market. That's almost 7 times more than the Treasury was actually willing to buy back. So why would investors be so desperate to sell? Well, we'll get to that and why it's happening later. But first, let's talk about the different types of bonds, because it's critical to understand the situation. Not all bonds are created equal. You have short-term Treasury bills, which mature within less than a year. Think your 3-month bond, for example. You have mid-range bonds that mature between 2 to 10 years, and long-term bonds, which mature from anywhere from 10 to 30 years. The U.S. Treasury's 2024 buyback program targets both ends of that spectrum, long and short-term bonds. Liquidity buybacks focus on older, long-term bonds issued decades ago that don't trade much anymore. Now, the Treasury has doubled the frequency of these buybacks from 2 to 4 times per quarter and increased the amount that can be bought back each quarter up to $38 billion. Then there's cash management buybacks, which are short-term bonds coming up to maturity. And basically the Treasury has increased the amount that can be bought every year to $150 billion. These are big, big numbers, guys. This hints at why the Treasury is doing the buybacks, but let's take a closer look at the buyback process to start to understand what the Treasury is really doing here and why this is so important. You see, on the surface, it looks like the US Treasury is actually being responsible for once. It's never the case, okay? Buying back their own bonds before they mature is like paying off your credit card early. Sounds good, right? Well, in theory, that's what you want. A government that has its fiscal house in order and pays back its own debts, but the American government's $37 trillion in debt. Not what's happening here, okay? Now, before we get into the real reasons here, guys, if you're trading the cryptocurrency markets right now, you need a good place to do that. That place is called BitUnix. Link right down below here. It's no KYC, no VPN exchange, meaning anyone, anywhere, that's you, can use it. Never been a better time to buy the rips, short the dips, whatever you want to do. And here's the deal. There's never been a better time to sign up. Link down below. You're going to get 30% off your fees. You're going to get a $400 deposit bonus after depositing $2,000 or more. You're going to get insane trading bonuses. Basically, the more you trade, the more money they put back in your pockets. And we're giving away $1,000 every live stream for the rest of the month of September. So go check it out. It's a credible time to sign up. Link down below. Back to this. What's happening? Well, the federal debt just keeps going up, with the deficit growing by $92 billion in the past year to $2 trillion in total. It means the government has a $2 trillion hole every year. Despite Trump's tariffs increasing revenue, okay, it's still a massive hole. So if the US government isn't actually reducing its debt with these buybacks, then what the heck is happening? Well, the Treasury is, for the most part, paying back long-term bondholders that won't mature for decades by using short-term Treasury bills with shorter maturity dates. So what's actually happening is the US government is repaying its long-term debt with short-term debt. And that might save a little on interest because short-term bonds have a lower interest rate, but it's still just moving deck chairs around the Titanic. It's not actually shrinking the debt. So if it's not about paying down the debt, well, why go through all this effort with the buybacks? Because whilst the US stock market is currently hitting new all-time highs, the US bond market has been in its greatest bond bear market of all time. Since 2020, at least on the long-term duration side, where investors are increasingly refusing to fund the deficits, there's problems. If there's problems in the US bond market, eventually that's going to spill over to everything. So it's fair to say the US bond market is experiencing significant stress, which if you look at the stock market, you may not see that, but the stock market strength is just painting over the cracks of the bond market. Long-term yields have jumped, with the 30-year Treasury reaching 4.83% in April, marking its largest three-day increase since 1982. Remember, bond yields and bond values are inversely correlated, so when yields spike, value drops. Most people watch the stock market, but the real danger is in the bond market. Credit rating agency Moody's already downgraded US debt earlier this year, meaning that it is becoming riskier to own US bonds. Now, it wasn't a big downgrade, but a downgrade nevertheless. That means investors now want higher returns for lending their money to the US government. It's a vicious cycle. The more debt America issues, the more expensive it becomes to borrow, and of course servicing the debt is horrific, and all of this pushes borrowing costs up across the board. So this isn't about just paying off debt or refinancing to more favorable interest rates. This is about the US government stepping in to try to get some water out of the ship before it all sinks. They need to stabilize the bond market and provide liquidity to boost investor confidence. It's all a bunch of bullshit, isn't it? But by doing so, the government is essentially creating the illusion of demand when the real buyers aren't there. The emperor has no clothes. It's all bullshit. The central bank monetary experiment is bullshit. Without interventions, yields on these bonds may be significantly higher, raising concerns about the long-term sustainability of US borrowing and growing deficits. And that sends a damning message to the rest of the world. The world's largest bond could no longer function without significant government intervention. And a bond market that needs significant government intervention, this constant lifeline, is walking on thin ice. Now, Bloomberg's Government Bond Liquidity Index hit a record of 6.5 points in July, signaling liquidity is now worse for the US bond market than during the 2008 financial crisis. Yikes! This sharp decline in liquidity is primarily due to increased government spending in the US and in Japan. Without the US Treasury buyback scheme, the cracks in the system would be much more significant than they are right now. These buybacks are kind of what's keeping the party going right now. Investors can no longer take treasuries for granted as a safe asset, but the US government can't afford a further sell-off. China, of course, is already trimming its holdings of US treasuries to a 16-year low. They saw what happened to Russia, right? With all their bonds being built, hundreds of billions of dollars of bonds being froze up. China doesn't want to be next to be targeted by the whims of the US government. And that's why the Fed has finally been forced to cut rates into stagflation to support the treasury and providing liquidity into the markets. But these measures can only buy time. They don't address the underlying issue. And that's why we own Bitcoin. You know I was going to talk about Bitcoin at some point in this video. It's true. The fiat system is a giant flaming dumpster. It always has been, and it's only getting worse. And if you don't see the writings on the wall for fiat, then I don't know what to tell you. And look, US adoption of stablecoins and stuff like that is probably going to extend the dominance of the US dollar a bit longer, but they're just going to keep printing. They're just going to keep manipulating. You know what doesn't get printed and manipulated? Bitcoin. Thanks for watching.